In this video, we are going to understand one of the most practical and important audit topics, test of controls. We'll understand this topic in 10 practical parts, covering the complete flow of how auditor evaluate and test controls during an audit. So let's begin. Part number 1, what are tests of controls? Every company establishes controls to prevent or detect errors and fraud. For example, approval before payments, journal entry review, bank reconciliation reviews, and segregation of duties. These are a couple of examples. As auditors, we evaluate these controls to determine can we rely on them. This process is called test of controls. If controls are effective, the auditor may reduce substantive testing, but if controls are weak, the auditor needs to perform more detailed procedures. This concept mainly comes from ISA 315 and ISA 330. ISA 315 focuses on understanding risks and internal controls, whereas ISA 330 focuses on how auditors respond to those assessed risks. In practice, test of control helps auditor to determine whether the control environment is reliable enough to support the audit strategy. Part number 2, understanding business process and walkthroughs. Before testing controls, the auditor first understands the business process. The auditor understands how transactions are initiated, authorized, processed, recorded, corrected, and finally reported in the financial statements. This understanding is obtained through inquiry, observation, inspection of documents, flowcharts, narratives, and walkthroughs. Now, what exactly is a walkthrough? A walkthrough means tracing one transaction from beginning to end. For example, in a revenue cycle, customer places an order. Then the sales order is created. After creating the sales order, the goods are dispatched and the invoice is generated. Post the invoice is generated, the entry is posted into the ERP system and revenue is reflected in the financial statements. During walkthroughs, auditors identify risk areas, key controls, system involvement, manual interventions, and possible control gaps. In practice, walkthrough meetings with process owners often become the foundation for risk assessment documentation. This is why walkthroughs are extremely important under ISA 315. Part number 3, relevant controls. Now, one important point, auditors do not test every control in the company. They focuses only on relevant controls. Relevant controls are controls that prevent or detect material misstatements, addresses significant risks, support key assertions, or are critical for reliable financial reporting. For example, revenue approval controls, journal entry review control, ERP access control, three-way matching controls, bank reconciliation review controls. So if I'll take an example of revenue, if revenue is a significant risk area, then controls over sales approval, dispatch, pricing, and invoice generation may become relevant controls. Auditors identify these controls while understanding business process, significant classes of transactions, IT systems, risks, and financial statement assertions. This is one of the most critical stage in audit planning. Part number 4, design and implementation testing. Once relevant controls are identified, the auditor evaluates design effectiveness. Here, the auditor checks is the control properly designed. For example, suppose the same employee creates vendor master, processes payment, and approves payments. Even before testing, the control design itself is weak because segregation of duty does not exist. Next comes implementation testing. Here, the auditor checks does the control actually exist and is management using it. The auditor may observe the process, inspect approvals, review system evidences, re-perform the control, or perform walkthrough procedures. One very important concept. Remember, inquiry alone is not sufficient. Management may say, yes, approval happens before payment, but auditor must verify this through evidences such as approval email, ERP logs, signed approvals, or Workflow screenshot. Part number 5, operating effectiveness of controls. After implementation, the auditor tests operating effectiveness. This means checking whether the controls operated consistently during the period. For example, suppose every payment above 5 lakhs requires finance controller approval. The auditor selects multiple samples across the year to verify whether approvals actually happened consistently or not. The auditor evaluates whether controls operated consistently, whether deviation exists, whether review was properly performed, and whether evidence supports operation of those controls. Even a well-designed controls become useless if employees do not follow it consistently. This is why operating effectiveness testing is extremely important. Part number 6, frequency and extent of testing. Now let's discuss a very important audit concept, frequency of testing. The auditors decide how much testing is required. This depends on frequency of control operations, manual or automated nature, complexity of the control, prior deficiencies, changes in personnel, stability of IT systems, and significance of the risk. For example, daily controls usually require larger sample size, whereas monthly controls require fewer sample size. Complex manual controls may require more testing, whereas stable automated control may require limited retesting. Controls over significant risk must always be tested on a frequent basis. In practice, auditor usually increases testing when controls are manual, there are prior issues, or significant changes happens during the process. Part number 7, understanding IT controls. Now let's understand what IT controls actually are. Today, most organizations use ERP systems like SAP, Oracle, Dynamics, or other accounting systems. Since financial reporting heavily depends on these systems, auditors also need to evaluate IT controls. IT controls are mainly divided into ITGC, or we call it as IT General Control, and Application Controls. IT General Control or ITGCs are control over the overall IT environment. If I'll take an example, user access management, password policies, program change management, backup controls, system operation controls. So these are the examples of ITGCs. Now coming to the application controls, these are automated controls inside the ERP system itself. So if I'll take an example here, automated depreciation calculation, duplicate invoice blocking, credit limit validation, automated three-way matching. These are controls which helps to ensure that the transactions are processed accurately and completely. Part number 8, timing of testing and roll forward procedures. Control may be tested at interim date or at year end. Suppose controls are tested till September, then for the remaining period, the auditor performs roll forward procedures. This may include additional sample testing, inquiry about changes, observation, monitoring controls. If significant changes occurred after interim testing, the auditor may need to retest controls again. Part number 9, prior year reliance. Sometimes auditors use prior year audit evidences, but this is allowed only when controls have not changed, IT system remains stable, no major deficiencies exist. Still, control must be tested at least once in every third year, and controls over significant risk must always be tested on a frequent basis. Part number 10, control deficiencies. Now what happens if deviations are identified? Suppose approvals are missing in multiple samples, then auditor evaluates whether the issue is isolated or whether the control is failing systematically. If too many deviations exist, then the control is not operating effectively. Then the auditor may increase substantive testing, test alternate controls, or stop relying on controls completely. Some deficiencies may even become significant deficiencies. Conclusion. So in summary, test of controls helps auditor determine whether controls can be relied upon. Here, the auditor evaluates relevant controls, design, implementation, operating effectiveness, frequency of testing, IT controls, interim testing, prior reliance, and control deficiencies. A strong control environment reduces audit risk and improves audit quality. Thank you for watching and see you in the next audit learning session.